What's up traders, Tom here with another video. Since the beginning of the QE policy, the stock market has been heavily manipulated to the upside. But has the Fed started to take their support of Wall Street too far? And are people starting to notice this? And are they coming under scrutiny? Stay tuned. Today we'll be talking about Jerome Powell's actions starting to come under the microscope, along with the latest stock market news and our technical analysis thoughts on the S&P 500, US dollar index, NASDAQ, and Russell 2000. We'll also be taking a look at gold, and we'll be diving into some of the smaller timeframe charts and talking about the trading ranges that we've been seeing. Remember, trading is very different from investing, and it's important to have possibly both when it comes to your money and management over the longer term. It provides more opportunity and a greater ability to have more flexibility in different instruments. So this one should be good. Remember to subscribe, hit that bell, and of course smash that like button if you enjoy this video. Our story today will start with the Fed coming under fire for the perception that they have prioritized Wall Street over Main Street, helping to fuel economic inequality by boosting the price of assets like stocks. This will become as no surprise to anyone that's been trading the stock markets or investing in the stock markets over the last couple of months. The central bank's policies have no doubt put a flaw in the stock market, and they've continued to show a strong upside potential to the stock market whenever we've seen bearish movements. Remember, they've been well timed and well calculated with their statements and with their policies during this period. But is that now starting to come under scrutiny? I definitely think so, and I think that will be the story of the next 6 to 12 months. I believe we're in some form of kangaroo market, where basically the stock market will possibly go to even new all-time highs over the next 6 to 12 months, but we'll see large trading ranges on the way up, with bearish and bullish action, and in fact better trading action over that period of time. So the Fed has been accused that the central bank has been bailing out big companies, and this accusation has been around ever since the dawn of QE. I don't think it's even a question that any of these policies really help large companies, and I believe that big companies will make more money than ever before over the next decade, purely because they will employ less people and they'll be able to, let's say, cut the fat. I've been speaking to even medium-sized businesses over this crisis, and many of them have just realized that they had more employees than they needed, and they'll be running a more streamlined system moving forward, which means more profits for them. But unfortunately, it means less people employed, and the government will have to try to do something about that. Quick update in terms of the news. Obviously, this crisis continues to hit records, and people are giving warnings about the ramifications of this crisis escalating. But at the same time, the stock market is very comfortable with what the Federal Reserve and what the current policies are doing. Remember, if that stimulus is passed by Congress as well, expect bullish momentum in the stock market. For now, we're in a large trading range though. I've even seen that there's now a study that warns of a possible new virus from pigs. So if that's true, things could get very scary over the next decade. So let's talk about the S&P 500 from a technical analysis standpoint. So one of the things that we've been seeing is the 3,000 level, the key psychological zone, has held again, with the market finding strong buying support and moving up over the last couple of days. It doesn't really come as any surprise as the market is bullish, because of course it's always bullish when it comes to the Fed's statements and the way that they word a lot of their statements recently. So the buying pressure is there, and in terms of which way I would want to be on, I'd always want to be on the buying side at this stage, unless we saw a very key break. And we've mentioned that the key break really needs to be under the 2950 and a close. Remember, close confirmation is key there. So I think the S&P 500 really offers more of a kind of trading thing. We mentioned the kangaroo market before. If you're seeing a kangaroo market where you're going to see a market go up and go down and trade in a large range, it's very unlikely that it goes off into the sun and makes 100% in a year based on what we're seeing in terms of the real economy as well. then you can find great opportunities. And of course, the buy side is always going to be a little bit stronger than the sell side in terms of you knowing that the Federal Reserve's got your back. So what are we seeing right now? Well, let's drop down into the 1 hour and talk about the current price movement and the key levels that we've seen. So one of the key levels that we've definitely noticed is been this 3080. It's been very key support and very key resistance. If we actually zoom out over here on the left-hand side, we've mentioned this as a resistance, being support, and then of course acting as resistance again, and then now acting as support in the pre-market. In fact, this was a great opportunity because not only do we have two moving averages here and a role reversal area, but we also have an inverse head and shoulders from the perspective of the 1 hour. So there's a few things that we like about this head and shoulders. One, the left shoulder is actually lower than the right shoulder. And as we mentioned, the big key thing when it comes to technical analysis is having the market momentum in your favor. You want to see the market participants pushing higher. If the right shoulder isn't able to come below the left shoulder, what that shows is that the market participants are keen to be in the market, they're keen to buy, and they're pushing it forward. That means that usually the slingshot effect of when the market closes above the head and shoulders area is going to be stronger, and there's going to be more buying pressure as the commitment of the buyers is more fierce. The other thing about this head and shoulders we mentioned, which is the dynamic support and resistance. So we have the dynamic level of the 200 moving average simple and the 20 EMA, two very key moving averages acting as dynamic support at that 3080 level. If we take a bit of a distance of what we expect from this head and shoulders, we usually expect it to go from the head to the neckline. Now, depending on where you want to draw that neckline, it can be, of course, the angled neckline, or it can be this horizontal one. I'll go with the horizontal because it's cleaner and easier to see. But there's a key point here that I want to bring out. Whenever you see a pattern showing you a point of take profit at the next resistance or support level, the key one, that's always a really strong sign. So here we have the take profit level being around that 3160, 3155 area. That's a zone that we've seen previous resistance at, and we would expect profit taking to happen at that time. Obviously, this is all statistics and it's all theoreticals, but that's the kind of thing that you want to see when it comes to technical analysis. We want to see take profits and stop losses that make sense. Another thing I want to mention is, remember we talk about in this channel all the time how the market likes to gravitate to key resistance and key support levels ahead of economic news. So theoretically, there could be strong buying pressure tonight. Let's just say that happened and the market pushed up to this zone. Now, if you then saw a very strong unemployment figure come out with the non-farms, then all of a sudden it would break that level and then would gravitate to the next level up here at the 3250. So very key kind of thought processes, and that's what we want to see. We always want to see the market gravitating to key zones ahead of news. It means it's acting more technically, actually. What are we seeing on the other pairs? Well, we're seeing again that the dollar index is unable to break that key level. Dollar index had a go last night. We can see here on the 4 hour, if we take that across, notice how it tried to close above that 97.60 zone. We've been mentioning 97.50, 97.60 on this channel quite a lot, and it failed again last night, and it shows you the importance of confirmation. If we saw a daily close above this zone, it would show a commitment of the bulls buying into the dollar index. But at this stage, weakness is coming back in, and this particular candle right now is looking quite weak. So we might see US dollar weakness. What about gold? Well, gold is at the zone that we've spoken about, 1790. It's quick, it's fast, and it's been a great move. And I'm sure many people are in gold on this channel. So that's a great move for a lot of people. Usually what you'll see with gold is you'll see gold try to go towards previous resistances and previous supports. We have a strong kind of resistance level just before that 1800 key psychological zone. But if gold is able to get up here to this zone, it's probably going to see some take profiting, sell off a bit, and if it ever breaks the 1800, we've talked about how it'll gravitate towards the next key zone, which is going to be 1900 US dollars an ounce. So gold for now, pretty bullish, but it's right at that point where you're going to need to be babysitting that kind of trade and careful of the next zones. What about the NASDAQ? Well, the NASDAQ has continued to bounce off the 20 EMA. We mentioned it's in a bull trend until it gets underneath this zone, or now if it makes a new high, it would need to get underneath this zone. We're not really seeing strong bearish momentum, and that is what we want to see if we want to go against the trend. Remember, don't just sell because you see it hit a new high. Wait for confirmation, and over the long term, statistics will be in your favor. Waiting for strong change of trends and waiting for that market momentum to come in is excellent when it comes to trading. Another thing that we've mentioned on this channel is the US 2000 or the Russell 2000. The reason we mention this is it's probably a better short tool if you're looking at shorting the index on key psychological level breaks like the 2950 on the S&P 500. If that was to occur, we have this really nice trend line going on here on the US 2000. In fact, this trend line has held now quite a few times. Big bullish hammer here, very, very nice. Big bullish momentum here. And while it's been weakening recently, until it gets under this trend line and probably the key level here of around 1360, we wouldn't be seeing much bearish action. Notice how this horizontal holds up at the same time as the trend line, creates a very strong bullish kind of level to be picked up off. And that's what has happened in recent days on the market. If it fails this level though, it's a key sell signal for the bears. And that's be something that I'd set alerts for and at least recognize it if it ever came up. You can set an alert, come back in a few weeks, and if you get that alert, you can say, oh wow, let's see if it's still in play and if it's still a key level. So Sweden's currency has seen the biggest rally in about a decade. In fact, most safe havens have seen huge rallies in them, and that's including gold, which we've seen break out and show considerable strength over the last couple of weeks. Basically, we are seeing a point where some people are incredibly concerned about what's happening, and there's still a lot of money on the sidelines. We saw investors are still selling at key zones, they're still investing at key dips, and I expect this kangaroo market style event to occur and to continue as we see unemployment figures, as we see other economic news, and more importantly, we see more company fundamentals come out over the next couple of months. If you've enjoyed this video, please remember to subscribe, hit that bell, and of course, comment down below with which trading instruments you're preferring at the moment in the markets. Happy trading, everybody, and we'll see you in the next video.